Hi guys, this is Vishah, and I'll be teaching P4 for what you call AFM, Advanced Financial Management. Um, let's first look at the format of the paper. The paper comprises of two sections. The first section has one question of 50 marks, and that includes four separate marks for the format. Those are called professional marks. Okay. In section B, we have two other questions, 25 marks each. Your syllabus, um, I have divided it amongst four core areas and other non-core areas. Four core areas include advanced investment appraisal, advanced risk management, mergers and acquisitions, option pricing theory. Um, the paper is going to come around 75% to 80% out of these topics. Now, the non-core areas include weighted average cost of capital, that is WACC, corporate restructuring, ratios, dark pool trading, austerity measures, and securitization. Austerity measures and securitization are theoretical topics, but other than that, all the topics are majorly related to calculations. Now, what is weighted average cost of capital? Weighted average cost of capital is basically the average cost of raising finance that a company incurs. What do we mean by the average cost of raising finance? When you are running a company, you know that it is not necessary that you will always have the finance available to yourself, available in your pocket or in your bank account that you can use to invest in your company, right? So you would have to go towards alternative sources to raise finance for your company, then invest it into the company and do the production and run your company in the due course, right? So there are four main sources of finance that a company uses. The first one is equity, then we have debt, then we have bank loan, and then we have preference shares. Equity is the finance raised through the issuing of ordinary shares. Debt is the finance raised through the issuing of loan notes or what we call debentures. Bank loan is the amount raised by taking a loan from the bank, and preference shares refers to the finance that you have raised by issuing preference shares. Now, preference shares treatment is done in two ways. It could be treated as a loan, it could be treated as an equity. Okay. Um, every source of finance through which you raise finance for your company has a cost. Now, what is the cost? For equity, you need to pay dividends to your shareholders. So that is denoted by KE. For debt, you have to pay interest to the loan note holders. So that is denoted by KD. For bank loan, again, you have to pay interest to the bank. That is denoted by KB. And for preference shares, you have to pay dividends to your preference shareholders. So that is denoted by KP. Now, the interest rate that you pay on debt and that you pay on bank loan can differ. It is not necessary that they have to be exactly the same. All right. Now, how do we compute cost of equity? We are first revising F9 back. The reason is that um, you cannot move on with P4 without revising your F9 concepts, but this is the basic of WAC. Okay, so you should know all of this because this is in AFM only. This is a part of AFM only. Now, how to compute cost of equity? Cost of equity has two models: dividend valuation model and capital asset pricing model. Dividend valuation model, the formula is P naught is equal to D1 over KE minus G, where P naught is your current share price, D1 is your next year's dividend, not this year's dividend, next year's dividend. KE is your cost of equity and G is your growth rate. You can mention it in percentages or in decimals, either way, it is fine. Now, there are two kinds of share prices that the examiner can give you in your exam. One is the cum dividend share price, and the other is the ex dividend share price. Now, cum dividend share price includes dividend, and ex dividend share price excludes dividend. So, for example, if the dividend is not given, but the examiner gives you two share prices, one is cum dividend and the other is ex dividend. So, you can subtract the two, and the difference would be this year's dividend. You can then apply the growth rate on it and you can compute next year's dividend. Clear? Here's an example. It says current share price is $10, dividend per share is $0.2, growth rate is 10%, and requirement is to compute KE under DVM. Now you already know what your dividend per share is, and this is the current year dividend. Current share price is $10, you put that into the formula. Growth rate is 10%, you put that into the formula. You need to compute your next year's dividend. So for that, you need to apply the growth rate on this year's dividend. So assuming that this year's dividend itself is 100% and you're adding a growth rate of 10% to it, so the next year's dividend is going to be 110%. So you can directly multiply 0.2 into 110% to get next year's dividend. Or what you can do is you can multiply 0.2 into 10%, whatever amount you get, add that to current year's dividend, and you'll get next year's dividend. Then you can compute your KE by dividing and adding. You get KE that is 12%. We should stop over here and give your feedback to the admin and then see you